Hi, it's Grant here, and in this video what I'm going to do is just explain, in my opinion, what I believe to be the fastest and least risky way to start trading options. Now, just so not to waste anyone's time, this video is really for options trading beginners, people who've never traded options before and they're interested in doing so. If you're a moderate to experienced options trader, you can click away because you're going to know well more that's in this video. So with that said, let's get on with the video. Now, the first thing to sort of talk about is, why should you even trade options in the beginning? Well, options contracts or trading options is a really great way to trade, in my opinion, because you can trade options and make profits whether the market rises or the price of a stock rises or the price of a stock falls. So this makes them the perfect sort of financial vehicle or sort of contract in order to sort of make money from the markets no matter what is happening. Obviously, you're going to need to know which way a stock's going to move, but hopefully I'll help you a little bit later on in the video. So with that out of the way, what is an options contract? If you've no idea what an options contract is, so I'm on Trusty Investopedia here. If you want to learn more about options trading, Investopedia is great. It will get you up to speed with the basics. But what is an options contract? An options contract is an agreement between two parties to facilitate a potential transaction on an underlying security at a preset price, referred to the strike price, prior or on the expiration date. Now, basically, just a few things about an options contract. An options contract has a number of things. So you've got something called the strike price, and the strike price is basically the set price in the options contract that you can exercise that options contract to buy the stock. So the options contract or the strike price is always set. You've got the expiration date. Now, an options contract will always have an end date, and the end date is called the expiration date. You can take out an options contract that only lasts one day, but you can take out options contracts that last a number of years. So you've got an expiration date, and then you've got something called the premium. The premium is basically the cost to either buy the options contract, but you can also collect premium as an options seller in order to receive money in order to sell an options contract. So those are the basics of an options contract. So I'm just going to read what it says here. So basically, there's only two types of options contracts that you can take out. You can take out a call option, and the reason why you take out a call option is if you think the price of a stock is going to rise above a certain price. But on the flip side, if you think the price of a stock is going to fall below a certain price of a stock, then you would take out a put option. And this is an important thing to understand. Buying an option offers you the right but not the obligation to purchase or sell the underlying asset. So if you take out a call option, for example, that contract gives you the right but not the obligation to buy that stock should the strike price in your options contract rise above the level that it make it profitable to do so. In the flip side, but options contract gives you the right but not the obligation to sell the stock in your options contract should it fall below the strike price. And another thing that's really important to understand, for one options contract that you take out on a stock contains 100 shares of the underlying stock that you are controlling in your options contract, whether it's a call option or a put option. So hopefully that sort of explains on a very basic level what an options contract is and the various options that you have. But let's get on to the important stuff here. And I've got my trusty whiteboard here. Sorry, it's really basic, but I just want to run over a couple of things with you. So there's so many different strategies in order to trade options, and some of them can get really complex. But if you're just starting options trading for the very first time and you're not sure where to start, I'm going to sort of run through some things with you. So hopefully, we'll get you in a better position in order to start trading options. So in my opinion, the fastest way to start trading options is to buy call options on stocks and buy put options on stocks. Just to recap, why would you buy a call option? Well, you buy a call option if you're eyeing up a stock and you think it's going to rise above a certain price limit by a certain particular date. So that's when you buy a call option. And you buy a put option if you think a stock's price is going to fall below a certain price by a certain date. And the beautiful thing about buying call options and buying put options is that the only thing you can ever lose is the money you pay in order to take out the contracts, i.e. your premium. So let's say, for example, you want to buy, say you think you're eyeing up Apple stock and you think Apple stock is going to rise above 140 by, I don't know, the 1st of March 2023. And like I said, in order to buy a call option, you need to pay a premium. Now, just say, for example, the premium to take out the options contract is $5 per share. And remember, there is 100 shares in one options contract. So in order to take out that call option, you multiply 5 by 100. So you'd have to basically pay $500 in order to take out that options contract on Apple stock if you think it's going to rise above 140. And just to explain, you're basically going to be in the money, or your options contract is going to be profitable if the price of Apple stock rises above 140. That is when you can either exercise the option and buy the stock, or you can sell the options contract and accept more premium, or you'll receive a higher premium than what you paid for it. And the opposite is for put options contracts. Say, for example, let's look at Apple again. Say you think that Apple is going to fall below $125 by March 1st. Then what do? You buy a put option. Your strike price would be 125. Expiration would be, say, be 1st of March 2023. And, like I said, you got to pay a premium in order to buy the put option. Say it's $5 again per share, 100 shares in the put option or in the options contract. So it costs you $500 to take the options contract out. If the share price drops below 125, you're in the money and you can either exercise the option to sell the Apple shares, or you can, basically sell the options contract and collect more premium than what you paid. So hopefully that helps you. But this is the easiest and least risk-averse way of trading options, because just say, for example, those trades don't work out for you. Say you're betting that Apple stock will rise above 140 by March 1st. If that doesn't happen and Apple share price doesn't rise above 140 by March 1st, then basically the only thing you can lose is the premium you paid. And the same with put options. The only amount of money you can lose is the money you put into it. But there's other, if you sell naked options, rather than buying an options contract, just say if you sell a naked option, so you've got nothing against it, then potentially your losses could be huge. So that is why it's always good to start with buying calls and buying puts, because the most you can ever lose is the premium you pay in order to take out the options contract. So hopefully that makes sense to you. So the next question is, what type of stock should you start trading when you're new to options trading? So really what you need to do is find stocks that have volatility. A stock that stays fairly flat in price. Whilst you can make money with those kind of stocks trading options, it's going to be difficult because options trading works best in volatile stocks. And whilst I must stress, whilst I'm not giving financial advice, I'm not recommending any stocks to you or anything like that. Some really good stocks that I personally look at and trade, and I know a lot of options expert does, are basically Apple, Tesla, Google, and SPY. These are traded fairly often by options traders because these stocks have a reasonable amount of volatility. But at the end of the day, my advice to you is keep things really simple. Focus on one or two stocks that have volatility, and you understand those stocks. You understand sort of like the price ranges, and basically once you understand the stock and the pattern for the price and it's got volatility, then you know you can start trading options with that stock when you know the price is going to move. Now, the real trick of trading options is knowing when to get in and out of a trade. And this is where the real skill of options trading comes in. It's timing when to get in to a stock and when to get out. And there's three things you can use in order to predict when a price is going to move. So when a stock, the price of a stock will move when a stock is over or undersold. Every stock will have, like a mean price, for a stock over a rolling 52-week period. If a stock goes too high and it's oversold, then usually if you can predict it right, a stock is going to move in the other direction because the stock is going to correct itself. The other way that you can sort of knowing when to get in and out of a trade, which is great for beginners, is focus on predicting price moves before earnings report. This is a great time to trade options because obviously if you've got wind that a stock you're eyeing is going to be coming out with a positive earnings report, you can probably bet with reasonable certainty that the price of that stock is going to go up. So you can get in a couple of weeks before. When the news starts coming out, the stock goes up. If it goes above your strike, then you can flip that options contract for a profit. And the last one is basically news events that will affect markets and stocks. For example, when the Fed, sort of give news that they're going to be hiking interest rates and inflation goes up, that is negative news that is going to negatively impact the market. But obviously, if there's a positive, news report, there's a certain event that's going to impact the markets positively, then that might be an indicator that the stock you're eyeing will go up. So you can place a call option accordingly. So, yeah, I want to keep this video short and brief, but this is, in my opinion, the fastest way to start trading options. I'm just going to recap for you. So when you get going, my advice is to only, focus on, only use call options or buy call options and only buy put options, because this is the easiest way to get traded because it's quite easy to do, but also it minimizes your risk because the only amount of money you can ever lose is the money you pay in order to take out these contracts. The type of stocks to trade are ones with volatility and sort of frequent price moves, because this gives you plenty of margin in order to trade with options contracts. And like I say, some popular stocks to trade with options are Apple, Tesla, Google, and SPY. Now, I'm not saying you go out and trade these, but I've traded them, and obviously a lot of others have as well. Now, like I say, the real trick of options trading is timing and when to get in and out of a trade. And I've given you these 3 points here that can be indicators of when a stock is going to make a move within a certain period of time. So anyway, guys, I hope this, sort of helped you understand options and it's giving you some ideas of how to start trading options quickly. But obviously, if your eyes have glazed over a bit and you're a little bit daunted by options, don't worry. When I started trading options, I've only been trading options for about 12 months. When I started looking into options, I found it really complicated. It took me quite a while to understand them. And I'll be honest, taking out my first options trade was terrifying. But it's only by doing that you learn. And also, you've got to expect to make mistakes. Unfortunately, as an options trader, you're not going to win every trade. You're gonna have losses, and maybe your first couple of trades you will lose money. But the more you trade, the more you learn. But in my opinion, the most sensible way to get started options trading is to follow an expert and basically hopefully get trade alerts from that expert. Because obviously, if you're going to go out there and learn it yourself, you can go on YouTube, you can read Investopedia, you can try and find stocks yourself. Whilst you can do it that way, it is going to be more risky because you don't know what you're doing and you could potentially make a lot of mistakes. And my advice is find an expert and follow them and get alerts from them. And I can highly recommend a trader called Larry Benedict. He runs an options trading service called One Ticker Trader, where basically he teaches his strategy of how to trade options called the One Ticker Retirement Plan. And basically he gives trade alerts on the stocks he follows. So basically he does all the work so you don't have to. So he gives you an alert and you just place the trade. And I can tell you that Larry is on a 12 trade winning run since his service launched last August. And across all of his trades combined together, he is up 240%. So I can highly recommend Larry Benedict's One Ticker Trader service. If you want to check that out, I'll leave a link below. It's only $19 to join. Special offer, only $19 to join, which will lock your membership in for a year and you get a 60-day money-back guarantee as well. So I'd highly recommend that. I follow him. He's great. And if you're new, I'd potentially follow him as well. He's very good. Anyway, hope you found this video useful and informative, and I'll speak to you soon.